And our first panel is divided on just how big the Fed's rate cut will be today. Harris Financial Group's Jamie Cox and Societe Generale Subadra Rajappa, there they are. They're both betting on a quarter-point cut, that 25, while new Century Advisors Claudia Sahm, here on set with us, is in the 50 camp. Welcome to all of you. Claudia, we'll start with you and the half-point rate cut call. What tips the scales for you?
We have seen some cooling in the labor market. Things are not headed in the right direction. We are not in a recession. A recession is not imminent. Monetary policy done by emergency is not good monetary policy, right? So if you can see where things are headed, make an adjustment. And at the end of the day, the reason they're cutting, whether it's 25 or 50, is we have made immense progress on inflation, and the federal funds rate is still very elevated. So as Chair Powell said, the direction of travel here is clear, and that's a real victory. I mean, given that we've had the inflation progress and we still have the growth in the labor market in a good place, but the adjustment, the normalization needs to happen. And frankly, I think we've learned in the last 7 weeks since the July FOMC meeting that the labor market just really wasn't quite as solid as they thought at that time.
And is that the key? And you're a labor market specialist yourself. So for you, does it come down to this sense that that last jobs report we had, okay, about 100,000 jobs were added. The unemployment rate has gone up significantly, and that's the most important thing?
Both the July employment report, the August employment report were disappointments, and then we had a preliminary revision, preliminary estimate of the annual revision to payrolls that really kind of took some wind out of the payroll picture. And so then this is a recalibration. To me, that's why you go 50 today. You recognize both sides of the mandate. You try to get ahead of what's some weakening in the labor market before it's an emergency. But the reason we're cutting is because inflation is coming down.
All right, let me stir the pot here a little bit. Claudia says, Jamie Cox, that labor market conditions are cooling faster than anticipated. You say, no, not so. Luckily, quote, the labor market remains stronger than anticipated. Make the case for why you think it's a quarter point, not 50, as Claudia does, and why you see the labor market as stronger than Claudia does.
Well, I've been involved in the economy now for a while, and I don't think that's going to change. But the biggest thing is what the Fed should do versus what the Fed will do. I mean, I think we all know that they tend to be a little bit late to the party when it comes to either raising rates or lowering rates. And it's not that I don't think that they should go 50. I just don't think that they're going to. Jay Powell tends to communicate. He tends to be a more conservative person. So I think when it comes down to it, when the decision is made, 25 basis points is here. And I think what they'll do through forward guidance is communicate what they think. And the balance of risk, I agree with Claudia that the labor market is the most important part. And if it comes to fruition that the labor market is indeed weak and weakening quicker than anticipated, then they can always go, faster and stronger in the future. And also, they also have plenty of other tools that they can do to lower interest rates. So I don't believe that this is a debate on whether the labor market is weaker or stronger. I think this is more about what Fed is going to do to be safe. I think they're going to take the safe play today, 25 basis points, and then let the economy sort of give it a little bit more data. The data dependency piece is still in place. And I think by the time we get to November, things will be a little bit more clear, and maybe they will go 50 at that point, but I don't think today is the day.
Subadra, why don't you jump in here? You're in the quarter-point cut camp. I guess if I were looking at the rhetoric that has come out of the Fed in recent months, it appears that they seem to be incrementally moving towards a greater focus on labor market issues and away from, they haven't declared victory over inflation, but moving away maybe from the laser focus on inflation.
Yeah, that's definitely the case. But, our base case is that the Fed cuts rates by 25 basis points today. But I'm very sympathetic to the points that Claudia made earlier. And if the Fed wants to follow the path of least resistance, it's going to be a 50 basis point rate cut because the market is very nearly fully priced for that kind of scenario. And there's a risk that if they don't deliver on that 50 basis point rate cut, that the easing of financial conditions we've seen with interest rates coming to the lows of the year, equities are near the highs, credit spreads extraordinarily tight, you could see a little bit of that unraveling in the market if the Fed doesn't deliver that 50 basis point rate cut. So that's what we're watching. I would say that the traders are much more inclined to believe that it makes sense for the Fed to front load some of these rate cuts, as opposed to being a little bit more methodical, given the fact that there are long and variable lags in policies. So it does kind of help the Fed to get ahead. The other thing is that they're going to have to somehow reconcile the spread between the rate cut that they delivered today and what's been priced in the market, not just for this year, but over the next year, where there's nearly 250 basis points of rate cuts priced in.